Portfolio allocation and the demand for assets. So actually, this is also a form of money demand. Okay. So, 不国语, what is portfolio? We'll look at page 281. What is portfolio? 4 words in Mandarin. No, that's just one of it. You can have stocks, okay? Assets. In terms of assets, it can be stocks, it can be bonds, right? Mutual funds, and of course ETF. Okay, so what's portfolio? I say 4 words. The first 2 is correct, okay? The first 2 is right, okay? Hold on. Yes, exactly, okay? A combination of various assets. And so here, expected return, okay? Basically, that's the interest rate, okay? And here it talks a little bit more about, how you gonna arrange, okay, all the financial assets you're gonna have. So risk, okay, liquidity. So, Huang Yufeng, what's liquidity? Huang Yufeng, liquidity. When you read newspaper or magazine, okay, when it says liquidity, basically that's money, okay? And if you're gonna explore more, liquidity is the easiness to turn into cash, okay? So money is 100% liquidity, okay? 100% liquid. Say bonds, okay, stocks is not cash, but is liquid. And as we mentioned before, right, M1A is equal to C plus D, okay? C is cash, so that's 100% liquid. And D is the same thing because we say, it's very easy to write a check or to pay any goods with your account, demand account. Okay, so liquidity, and then time to maturity. So if you buy ETF, okay, there are 7 kinds of ETF. So, for example, here is some, say, 10 years maturity, 20 year, okay, 30 year, okay. So this, and maybe, 5 years. So what's the difference here? What is the difference? This is time to maturity. Sometimes people have 1 year, okay, or 6 months. So in your opinion, what is the difference here? Beijing. So different maturity, right? This is long term, very long term, extremely long term, and this is short term, and this is mid term, okay, middle. And here is very short term. So in terms of the ETF or the portfolio you're going to buy, what would be the difference? You imagine that. Think about it.
到期日不同。
Okay. And so what about the interest payment? Which one going to give you better interest payment?
因为长天期的。
Exactly. So long run R is greater than short run R. So long run interest rate is greater than short run interest rate. Okay? But there will be more risk. If we talk about T-bond, okay, generally this is going to be T-bond, okay? The other one is called corporate bond. Corporate bond is issued by companies, okay? So generally, governments, okay, we call T-bond, treasury bond, it is more secure than corporate bonds because government generally will always be there, but companies is different. So, still a lot of people will buy T-bond rather than corporate bond because it's more secure, it's safer, okay? Because government will always be there, even though the interest payment will be lower. But if you are risky or you prefer more risk, okay? You prefer more risk, you can buy corporate bond, okay? And if it's long term, okay, generally you're going to get more payment out of it, but the fluctuation will be higher, okay? So in terms of, some investors, they prefer stable income, okay, the short term, okay, rather than the long term. And the longer the maturity, okay, then the fluctuation will be more, okay? So it depends on what you think of it. So first of all, on page 282, right, risk, okay, and then liquidity, and also time to maturity. So, 石玉婷, what's maturity? Maturity, what is maturity? M-A-T-U-R-I-T-Y, maturity. What is maturity? Xu Jiasen, what's maturity? Okay, good. Okay, so page 283 is talk about long-run interest rate is higher than short-run interest rate. Okay, that's for sure because you have to bear more risk. You don't know whether, after 5 years, 10 years, whether the company still be there or not. Okay. Okay. Page 284. It says about types of assets and their characteristics. In Department of Money and Banking, our department offers a lot more courses. So we are here discussing macroeconomics rather than investment or your financial strategy. So we're gonna skip this. Okay. And then we talk about two crises. Okay, one crisis in 1980s. Okay, the other crisis is 2008. And these two crises are actually quite similar. Okay? Okay, the economy is good. Okay, the economy is good, and so people get more income, and also get capital gains in the stock market, and then people buy houses. Okay, and then buy houses you have to have mortgage. Okay, mortgage. And banks lend people money to buy houses. But when people have money, the demand for housing going to go up. Okay? And so because of that, the market is going up. The banks are more willing to lend money to people. And more people get more money, and then housing goes up much more. Okay? So basically, banks are pro-cyclical. Banks are pro-cyclical. Okay? Banks are pro-cyclical. What does that mean? 正财经. So banks are pro-cyclical. What does that mean? Pro and cyclical. So what is cyclical? Exactly. Okay, pro-cyclical. Pro means the same direction. You have something we call counter. Counter-cyclical. That's the opposite direction. Okay, so pro-cyclical. So for example, the economy is good, you will be good. Okay? And so let us say the companies make good profits. And so banks are more willing to lend money to companies doing good businesses. And so when they got better, banks gonna lend more. Okay, but if companies they suffer from their business, what will bank do? The bank will take the money back, right? So remember that, it is kind of interesting. This is the same thing in English and in also Mandarin or Taiwanese. Because they lend umbrella to companies when the sun shines. But when it rains, they take the umbrella back. So what is that? 郑彩金. When the sun shines, they lend you umbrella. But when it rains, they take the umbrella back. In Mandarin, 公司云。
有阳光的时候把雨伞收起来，
Right?
然后下雨的时候，这样，就是反过来。
So what's that?
雨天收伞，然后晴天开伞，然后
Lend. L-E-N-D, lend. Okay, 朱广彦. 公司云 is right, but we need to make it better, refine it. What's that? Oh, exactly. Okay, so that's how it works. Okay, so let's try to figure out what happens. So there are two crises. One's in 1980s. The other one is 2008. And basically that's the same thing. Okay. When the economy is good, okay, everyone feels good. And the market is good. The stock market is good, the housing market is even better. And so then what happened? The central bank gonna worry about inflation. If central bank gonna worry about inflation, what would they do? Chen Yuxiang. If central bank worry about inflation, what would they do? Just like 2 years ago, when there's inflation, what did the central bank do? Yang Junxiang. Remember that 2 years ago, when we have inflation, what did the central bank do on interest rate?
Increase.
Okay. So interest rate goes up. Okay. Then it costs more for you to buy a house. So all the demand going down, right? So then because of that, when interest rate goes up, bond price, what happened? Goes down. And mortgage, to a certain extent, is the same thing as bond price, okay? Because you get fixed income out of it. So mortgage goes down, okay? Value goes down. But as you know, when the bank lend money out, it is considered an asset, right? So the asset value goes down. What happened to the bank's balance sheet? Okay, balance sheet. So, Li Boyan, what is balance sheet? You have taken accounting, right? Balance sheet. The other one is income statement. Income statement, balance sheet. What is that? 林伟轩, balance sheet. Louder. I heard it.
资产负债表。
Exactly. So what does that mean? Your asset going down. So the banks, as I said, they are procyclical, right? When the economy is good, everything is good. But when the economy is down, it's the opposite. And so because of this simple policy, okay, 1980s, the crisis is because of interest rate go up and then mortgage go down and balance sheet of the banks is going down. A lot of banks are in trouble. And that's the same thing, right? It's even closer to us. So housing is going up, right? Everyone is buying house. But when interest rate goes up, what happened? Housing market is going down. When housing market is going down, mortgage gonna go down, and assets gonna go down, and banks gonna go down. Okay? So just talk about interest rate. Okay? It has a lot of impact on the economy. And we just mentioned about long-term bonds and short-term bonds, right? So you see there's a lot of risk associated with all these kind of portfolio. So sometimes you got to be very careful with all this. So page 286, okay? This talk about housing crisis of 2007 to 2011, but actually, if you look at 1980s, that's exactly the same, okay? Okay, let's turn to page 289. The demand for money, okay? Demand for money. Okay, the price level, the income level, okay? So page 290, real income level, and then interest rate. And then they talk about money demand function. This page 291, okay? Page 291. So you have MD, okay? So money of demand is equal to P multiply liquidity, okay? Liquidity is money demand, and of income, that's Y, and interest rate, okay, that's I. But usually, you know, in my class, my notation is different from the textbook. When we talk about interest rate, we use R, okay? When we talk about interest rate, we use R. Okay, let's move on. Okay, so page 292, you look at equation 7.3, okay? There's one more variable. The variable is pi e, okay? What's pi e? Expectation of inflation, okay? Pi e is expectation of inflation. And then we talk about other factors that affecting money demand, okay? Wealth, risk, liquidity, and payment technology, okay? We're gonna talk a little bit more about payment technology. Page 293. Okay, because now, most of us, because you don't have a job yet. So anyway, how many of you have credit cards? If you have credit card, raise your hand. One. Feng Jie, do you have credit card? Okay, your father's. Do your father needs one more son? No? Really? Just call him, right? Maybe he should like to have me as his son, right? Because I teach you microeconomics. Anyway. So anyway, I'm not joking here. If you use credit card, generally, you don't have to have money in your pocket, right? And you just swipe it, okay? And for example, you know, if you have to pay cash for McDonald's, you will look at, you know, the menu and be a little bit more careful. But suppose you just use credit card, what would you do? You just pay for it, right? So if you use credit card, this kind of payment technology generally, okay, will increase inflation, okay, because you readily pay more. Even though credit card is not money, right? But it's like you're borrowing money. So you borrow to pay, okay, so new technology. But, okay, this is for credit card. But suppose you use debit card, okay, so what's the difference? Pan Ziyuan, what is debit card? Okay, so what is the difference between credit card and debit card? Right. For debit card, you have to have money in your account. Okay? For debit card, for example, if you go to post office, right? You have post office account, right? And usually you get a card, that can withdraw cash from your account, and it also serves as a debit card, okay? But so let us say you have, $10,000 in your account, but you swipe it, you pay for $20,000. Does it work? It doesn't, right? Because you don't have that much money in your account. Okay, but in the United States, okay, it's different. Even though you use debit card, right? Supposedly, if you have $10,000 in your bank, okay, but you swipe a card for $20,000, it will work, but they will charge you for a loan. Okay, they charge you more, a surcharge. We just talk about this word, right? A surcharge. So in Taiwan, it's different, but in US, okay, it works, but you have to pay extra for the money you pay for it. But don't do that because it's very expensive. Okay, so here 293 payment technology. A little bit on that. So and also we talk about the difference between credit card and debit card. Okay, and then we get to page 294. Okay, this is Bitcoin currencies. Okay, so what's Bitcoin? Bitcoin is not a money. Okay, it's not money, never, because it fluctuates just too much. When the Bitcoin just came out, it is just several $100s, and now, okay, when Trump got inaugurated in January, it reached more than $100,000. Okay, and now for several months now, because people fed up with Trump and also Elon Musk, it went down to something like $70,000. So that's 30% off. Okay, so it fluctuates too much. So you cannot be served as a unit of account, and it's very difficult to use it to pay something. So it's never a good medium of exchange, and so it's not a store of value because it just loses value so quickly. So Bitcoin is not a money. Okay. Okay, then we get to page 296. Okay. It talks about velocity and the quantity theory of money. And if you look at page 297, okay, you see that this textbook, okay, is the Ben Bernanke is one of the authors. It's different from most other textbooks. Some other textbook would say velocity of money is constant, okay? But you look at figure 7.3, you can easily see M1 velocity is not constant, okay? M1 velocity is not constant. So let me show this again. So MV is equal to PQ, okay? What is this? This is price level. This is real GDP. And so what you get here is nominal GDP. And M is the amount of money you have, okay? This is the amount of money you have. And this is velocity of money. The number of times $1 is used to buy goods. Okay, the number of times $1 is used to buy goods. If you look at most other textbooks, they're going to tell you if this goes up, this will go up. Okay? And if this goes down, this will go down. But it is not the case. Okay, for example, if money supply goes up a bit, quite a bit, what happened? In this case, because you see the money supply is increasing, so generally it will affect price level. So price level will be going up. If you see price level is going up, what would you do? You will buy more. So this one gonna go up. So then what happened? Price level will go way up. Okay, let me repeat this again. if people see money supply is increasing, okay, and that will affect price level. So for example, last year when the price of, it's happening now in the United States, the price of eggs are going up. So what would you do? You buy all the eggs in a hurry. So what happened? Okay, the price of eggs will go up way higher. Okay, but if it is the other way around, say, the money supply goes down. Okay, if money supply goes down, price level generally will go down. Okay, but what happened? When price level is going down, you expect it to go further down. Okay, so for example, recently we have a lot of cabbage. Okay, so Wang Jiaxuan, what is cabbage? Cabbage. Okay, exactly. It's going up or going down? The price going down, right? So what would you expect? You're going to buy more? No, you wait for it, right? So the velocity of money is going to go down. Sorry, here. So what does that mean? When money supply is going up, velocity of money will also go up. And this will make the price level go way up. Okay? But if money supply is going down, okay, the price level is going down, what would you do? You will buy less often, and you will wait for price to drop. So this one, velocity of money will make inflation worse, okay, if it is going up. Also, it will make deflation also worse, because when it is going down, people are going to wait for the price to go down rather than in a hurry to buy more. Okay? So this is quite important here. And it is mostly different from, what other textbook talk about. So this is a good one, okay? If you check, for all the textbook that I have seen, most people say, V, velocity of money is constant. No, it's never. Okay, so here, Ben Bernanke said very clearly, the velocity of money is not constant. But of course, if you look at M2, right, it sounds like flatter, but M2 is much more broader, okay, much broader about, the amount of money you talk about. But M1, okay, is C plus D, so fluctuate more. Okay, and then if you look at page 298, figure 7.4, so you can see the fluctuation of M1 and M2. So generally, okay, you see that it's generally that if M1 increases, okay, GDP will also increase, okay? So as we talk about the business cycle before, right, we say money supply, okay, is a very important factor of business cycle. Okay, page 299, it is about asset market equilibrium. And, this is a little bit different from what we would talk about in Taiwan. So, just forget about it. And page 301, as I mentioned, in our class, when I say money supply, okay, when we talk about this diagram, M and R, okay, in our case, this is real money balance and this is real interest rate. But, this book talk about nominal and real. In my opinion, it doesn't make much sense out of it. So here, you see that equation 7.9, you have M over P. Forget about it. We will not talk about that, okay? And page 303, application, it said money growth and inflation in European countries transition. So, basically, you have we call Eastern Bloc. Okay, there are several countries that sort of we call belong to the communist regime. So you have Soviet Union, okay, and then you have Poland, Czechoslovakia, Yugoslavia, all these countries. They used to be controlled by communist, okay, party. And when it is under communist regime, and after the communists are gone. So anyway, let me make sure that you get what I'm talking about. Chen Youxi, what's communist? Communist party. So China is controlled by a communist party. So what is communist party? 3 words. Exactly, communist party. Okay, and Soviet Union, of course, it is controlled by communist party, but that's before 1992. After 1992, Soviet is gone. We now call Russia. Okay, and Poland, all these countries. So in the past, it was controlled by communist party, and so a lot of things. It is not free market. Okay, that's it. It's not free market. But then after the Communist Party is gone, people expected to free the market, and so the money supply increased. So you have inflation also. It's a long story. So if you want to read more, that's fine. And I think it will encourage you to know more about how the market works. Okay, money supply increases, and a lot of investment coming into Poland, okay, Czechoslovakia, Yugoslavia, all these countries, and it is booming. Okay, the economy is booming, but then it takes a while to get all the investment, to get going, to get the infrastructure built, and all the companies, factories built. But when the expectation is not very good, it turns out, there's going to be something wrong. So anyway, and so let's look at page 304. You have figure 7.5. Okay, let me read this to you. Okay, if you check all the dots there, right? So to the further left, that's Belarus, the Belarus. So, Huang Weixin, what's Belarus? See that? You should check with her. And then you have Bulgaria and Turkey. So what's Bulgaria? Exactly, good. And Belarus, the rightmost, Belarus. What's Belarus? Exactly. Okay. So let me read this to you. It said, the relationship between money growth and inflation. Okay, it said nominal money growth and inflation during the period 1995 and 2001 are plotted for the European countries in transition, for which complete data are available. Okay, there is a strong relationship between money growth rates and inflation rates. Okay, that's exactly what we say there, right? Okay, money increases a lot, inflation will increase a lot. Okay, so that's exactly what the exchange equation tells us. And so some countries have money growth rates in excess of 80% per year, also have inflation rates in excess of 80% per year. Okay, so you check the diagram here, right? Okay, here's the diagram. If you have really high money growth rate, what you get? Very high inflation. Okay, So that's exactly what the diagram gonna tell you. I'm not quite sure about velocity of money, but I suppose velocity of money will increase quite a bit. So that will, aggravate the situation. Aggravate means make the situation worse. Okay? Okay, and then page 305, you have figure 7.6. Okay, they talk about inflation and nominal interest rate. So inflation goes up, nominal interest rate will go up too. And then page 306, it talk about inflation expectation and linkers, right? Inflation expectation, how does it work? If you expect inflation to go up more, you have higher velocity of money. If you have inflation expectation going down, and this one will go down too. So V is actually quite important in terms of looking at the impact of money growth. Okay, that's it. Chapter 7 is done. So next week, we're going to talk about the policy tools of central bank, and then we will get to ISLM curve. See you next week.